We've been talking a lot recently about the potential for the US 10-year Treasury yield to rise above 3%. 3% is a big round number, and we like big round numbers when looking at levels. Could it go higher? What are the implications for this in terms of some of the other aspects of the markets? Well, let's take a look at this now from a technical point of view with Ron William from RW Advisory. I don't want to get too much into the fundamentals on this and too much about what it means to other markets, but let's kick off first of all with the point that we were discussing last week when we were talking about the VIX index and the fact that this demonstrates people's fear for the markets. What does the bond market tell us, and what's the crossover between the VIX and the bond market yield curve?
Well, the yield curve is very much a transmission of fear as we speak at the moment, equal to, if not greater than the VIX, because so much is associated with that rise. At the moment, we're, looking at the chart, about to rise. We're just 10 basis points away from that 3% round number, with a potential spike risk. But that rise is now much greater than inflation expectations. That the chart B there just showing the rise in yields versus break-even. It's the widest gap since 2009. And of course, it's something to watch now in terms of the fears, not just behind the yield itself, but behind fiscal policy in the States and how some of the policies are actually going to be funded, and also how this might affect the equity market.
Yeah, bottom of the first chart on the left-hand side there, you've got 4 previous rate hikes. Explain how the rate hikes feed into what's going on in the bond market.
Yes, well, I mean, most technicians or people that follow the mood of the market and believe that drives the market suggest that the Fed follows the market and not the other way around. That can be shown when looking at the short end of the curve versus the Fed rates. But here we just see that there were 4 hikes last year alone, and 2015 was really the turning point from crisis-era policy following the global financial crisis, and all that was taken place in order to actually alleviate the situation. Here and now, of course, there's an expectation of 2 to 3 hikes. Some say maybe 4. But either way, my suggestion there from a technical perspective is to watch the market, because that will likely give you a lead indication as to what the Fed will do. And the other thing is keep your eye on the equity market, because the short and the long end of yields is actually rising at the same time, what we call steepening. And that is a major signal for equity market pressure, but also economic recession. Yes,
let's bring the chart back up again, because in the bottom right-hand corner there you do have this steepening yield curve pressures on the equity market. Now you've got a big orange box on the far right-hand side there. I think this chart does bear some explanation. The orange line is the S&P 500, isn't it?
Yes, it is, and so that's the very strong parabolic rise that we had into the new year, the happiest new year since 1999 on the S&P 500. So we had a very strong move. We then obviously had the flash crash that followed through, and in our last discussion we spoke about how the VIX breakout from a 3-year compression actually confirmed that move and led to a lot of excess volatility. But one of the unsung movers of the flash crash that we currently see on that chart is yield, and that rise that we've seen. And this is a combination of the 2 and the 10-year actually rising early in Jan, but really accelerating ahead of this move and potentially adding to the pressure.
Yes, this is the spread, isn't it, between the 2 and the 10-year and the steepness of the curve. Let's bring our second chart in, because I think this is interesting to put this into some sort of context about a longer period of time, because the second chart goes back to 1985. Now this gives us, on the far right-hand side, you can see the little uptick that we got up to almost 3% is where we are at the moment. Explain more about this. Clearly you've got a 31-year trend regression channel that you've drawn in here.
So cycles is a big part of what I do, and this shows the very long-term bear cycle in yields, bull cycle in bonds, which most people have been aware of over its duration. We've had several times of actually testing the top side of this channel or regression line that I'm actually drawing in. That current level is around 3%. But what's more important, less about the level, is actually that we developed a bottom in 2012, what Bill Gross went on record and spoke about quite clearly. But we then continued in that bottoming phase into 2015 and really developed a very strong accumulation pattern or double bottom pattern, which we're now looking like we're about to alleviate to the upside. But that move is unlikely to be an event. That move is likely to, that normalization, that long-term normalization is likely to be a glacier gradual process just because of the nature of the long-term trend. On average, interest rates have a 30 to 35 year trend up or down, and that's chart B there just showing that evidence.
Yes, that B one is the small chart in the top right-hand corner. Let's take a look in some more detail about that double bottom you spoke about and bring up chart number 3, because we've got this double bottom that we've seen when we get the yields drop right the way down to the bottom. We've got an inverse head and shoulders as well on the bottom right-hand corner. Explain where you think the markets are going to go from here using this technical analysis.
So this is just a zoom in of what we're just looking at now, but over the most recent few years. And what that shows is that double bottom in 2012 to 2015 is also now actually part of a even better timing pattern, a reversal pattern called the inverse head and shoulders pattern. And this time actually it's triggering a move not into just 3.5%, which I think is in line with most consensus views out there, but also a potential risk, a spike risk into just under or into 4% itself. As a worst case scenario, this would be the event. Which could easily happen towards the end of this year. Time will tell as and when, but it's certainly the risk to the upside of a spike event.
Explain spike event in more detail, because that to me is a very, very sharp move up or move in one direction and then a sharp pull back. Is it up there long enough to cause much disturbance?
Yeah, very much. I mean, 3.5%, I think the view, it's very difficult to tell what would be the pain threshold for the market, particularly the equity market. But it used to be 3%, now it's 3.5%. Between 3 and 3.5, I think the consensus is the market, which should be able to sustain that. But I think over and above that would be the real tipping point for the market. So this would likely be the kiss of death for the bond market, but also the equity market. But ultimately, this would lead to this would be potentially a deflationary spike. So a lot of people might read it as an inflationary gauge, but actually, it's already surpassing inflation expectations. A spike is actually more to do with fear than it is than trader fear, and potentially some kind of default risk in the mix ahead. So it'll be some black swan event of some sort leading to that spike. But a spike in nature will be a mean reversion, a very knee-jerk mean reversion back down again, more than likely into the channel.
Okay, your final chart gives some historical backdrop to this, doesn't it? Explain more about this. On the left-hand side, this goes right the way back to before the 1920s crash.
Yes, so we had the 1929, the famous 1929 Wall Street crash, peak and crash. But it's halfway after that crash, it's lesser known, but in the bond market, in the yield market, we actually did have a spike of about 1.5%, which led to, back then, 5.5%. And that's what then led, that was a deflationary spike, and that's what led to the deflationary spiral thereafter, which continued into the 1940s before the bottoming out process took place, and then we had the post-World War boom thereafter in the economy and in the stock market. That is as an analog example of what we could experience. Of course, it's a historical rhyme, but not an exact comparison of things. Obviously, this time is different in so many ways, but in terms of just a potential blueprint of what we might see, it could be quite similar to that. And I've just shown it there on the right, that deflationary spike outside of the 35-year fall in rates, and then back down again before we actually start to see that long-term reversal from down to up, more than likely into the end of the decade, into 2020.
I was going to ask you actually as a last comment on this, give us some dates and some timescales on this. Going back to the last chart, you're very much a person that uses cycles. You talk here, there's a number of different time intervals you've got here on the right-hand side of this chart here. What period are we talking about here? You've got 2018 as a question mark here on the right-hand side.
Well, 2018 is certainly heightened risk for this spike scenario. In terms of the bottoming out phase for the market, for yields, I think that would continue from 2019 onwards. Certainly the steepening yield curve suggests a 6 to 18 month lead signal for equity market pressure, but then also economic recession. And that's in line with my 2019 cycle trajectory. I think that's when we start to get a lot more excess volatility and further shock. And all of this will set up the next boom in the equity market, and ultimately the next bull cycle in rates, which will likely be fueled by commodities as well. So, inflation will come, but not as in a very long-term basis. It'll be probably a few years off.
Good. Okay, Ron, thanks so much indeed for taking us through your expectations. Potentially they're using some technical analysis around the rise in bond yields that we've seen, with Ron's expectation of a potential spike up in yields at some time in the not too distant future. Ron William joined us there from RW Advisory. Subscribe to IG for educational content, company insight, financial analysis and expert commentary.